Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, the Federal Reserve rate decision due out in just a few hours. We'll bring you everything you need to know. Plus, Oracle is set to report after the closing bell. We will talk all things AI and get a read on enterprise spending. And we'll go live to Apollo Global Management for a full day of C-suite interviews. For right now, let's take a look at what's going on with the major averages. And the short answer is not a heck of a lot. We've got a mixed picture. Of course, everything could and is likely to change after we get the Fed rate decision and the press conference from Jay Powell. So we've got the Dow up by about 100 points or so. The S&P 500 very little changed, almost at zero. And the NASDAQ Composite is down 0.25%. Let's take a check on yields ahead of the Fed rate decision today. Right now, yields of 4.19%, and they're not doing anything today. So we do have this waiting game that is going on. But as we've been talking about here, we've had rates trend lower for the year to date, but kind of take a little bit of an upswing over the past month or so. So that's something that we've been watching. If you look at the 30-year, that has also been the trend. And that's something that a lot of people have been talking about that we will talk more about in just a few moments. We'll also be watching Bitcoin. Investors in the cryptocurrency have been awaiting this cut as a potential catalyst here, but we've seen Bitcoin up a little bit off of the lows, but and up a little bit today. So that'll be interesting to watch. Sector-wise, within the S&P 500 today, as we have that little change, what's that balancing act look like? Well, on the downside, we've got tech that is lower, industrials and healthcare that are getting a little bit of a lift. So again, quiet session ahead of the news that we are awaiting. So let's get to that and talk more about it. Long-term interest rates are actually rising despite the Fed cutting cycle. This chart is from Apollo chief economist Torsten Slok. It shows that when the Fed starts cutting, usually long-term interest rates decline as well. That happened in 2001, in 2007, in 2019. But as you can see from these charts, one of these things is not like the other. 2024, we saw the 10-year yield go up and the Fed funds rate came down. And we have continued to see, as I mentioned earlier, rates kind of start to creep up over the past month or so. Let's talk more about this phenomenon now. Joining me now is Christian Hoffman, Thornburg Investment Management, Head of Fixed Income and Portfolio Manager. Christian, thanks for being here. So we are, of course, awaiting the Fed decision, what many people are expecting and characterizing as a hawkish cut today. If the Fed is cutting, and if it's expected to continue to cut, what's going on with rates? Why have we seen a little bit of an increase on that long end of the curve?
I'm actually constructive on rates at the end of the day. I think we're going to get a hawkish cut, and you have the concept of buy the news or sell the news. But I think people were de-risking and positioning into this meeting. I think we're actually going to get what the market expects, and I actually could see people buying bonds post this Fed meeting because of the de-risking that's already taken place. Now, amidst the backdrop, some of this is going into the Fed meeting and positioning, but you also have, I think, bigger questions of what's going on. As people look back at the year 2025, it has broadly been a very good year for fixed income broadly. It has also been a year where globally central banks have been easing. If you look at the year ahead, we're not going to have quite the same tailwinds that we've had, particularly around the globe. So you've had benefits from both spread and duration this year. I think both of those are more challenging going into 2026, and the picture for more volatility seems like a strong base case. You also have the concept of the changing of the guard in the Fed and what that might mean for inflation and monetary policy.
So there's a lot to dig into there, Christian. So, yeah. What do you think is going to happen with rates next year? Right now, I believe the market's pricing in 2 more cuts potentially next year, which is, it's been going sort of between 2 and 3. What do you think is most likely?
Yeah, I think the most conversations revolve around the number of cuts in 2026. I think it's more interesting to get a bit more granular. I think we get likely at least another cut in the first half of the year, but it's really the back half of the year that is a much more interesting picture. You have a changing of the guard in May, and if you think about it, we're still in this period where there's a lot of uncertainty around the data, frankly, because we haven't had as much data as we usually have, and it's happening amidst the backdrop of what Powell has deemed a fog, where it seems like there's a lot changing with the underlying economy. So I can make a reasonable case where 6 months from now, the economic picture looks notably better than it has. I could also make a pretty credible picture that it feels quite a bit worse. So, if you're on path A, I think the case for doing very little is going to be pretty strong. In the case for path B, where if things feel notably weaker, you're going to have consensus around a much more dovish policy and needing to try to rescue the picture if that's the path that we're going down. But it's important to note that the visibility is pretty low right now.
Christian, we are going to get a new Fed chief pick at some point, right? Maybe in the next couple of weeks, we shall see. Who would be your pick for next Fed chief?
I would love to mix it up a bit and see someone who isn't a PhD in economics. I would love to see someone who's more markets based. So again, I could pick some of my favorites, but the favorites that have been mentioned are, Rick Reeder, someone like that. Again, that's someone that's been floated and someone that actually has a background in taking risk and dealing with markets, I think would be a nice change to see.
That said, who do you think is, do you think it is going to be Hassan? And if so, what does that then imply about the path for rates?
What we're seeing is a market test of Hassett. So what we've seen is, hey, here's maybe my pick. It's Hassett. What do you think? And there has been some pushback against that, but I think prediction markets are right in anticipating that it's kind of a 70 to 80% chance that, this is the person that we're going to get. Over the last year, I had a real fear that we might have seen Caligula's horse get named, into that post. So getting a person with a real background who has, some credibility, this is not the worst pick that we could have.
Yeah, well, that's sort of the playbook. I was just going to say that's sort of the playbook in general from this White House is put out the scariest thing possible so then you can do something that's a little less scary and it looks safe. But anyway, go on.
No, this isn't the worst pick that we could have, and I think the other thing is this is not one person, making a decision.
Right.
You're going to actually have a group of folks who are probably going to look at any new individual with some skepticism. So that person is going to need to build consensus around the table, and they're going to want to establish their credibility with markets in the early days because, if you're not coming in with credibility, it's going to be bad for markets and for volatility overall.
Let's go back a little bit to the fixed income outlook for 2026, and I'm curious what your broad sort of strategy is when it comes to that market.
Look, this is a time when you can take some risk out of portfolios. So fixed income, I think, we've seen very strong results in fixed income across the board in 2025, but real yields continue to be pretty compelling. While spreads are tight, it doesn't mean you have to hide under the bed, that you can still take some risk. But I think you want to take an appropriate amount of risk. So if you're running a fixed income book with a 2 to 4 duration, you're really getting 70 to 90% of the compensation as you would get from the ag, but you're doing it with about half of the volatility. So one thing we're talking about with clients is that there's anything but a linear relationship between compensation and the duration risk that you're taking. Spreads are very tight. So I think you need to be cautious there. I think you need to have some dry powder because we will see some backups during the year. At the start of 2025, no one thought, there was any case for volatility, but that didn't stop high yield spreads going from the mid 200s to the mid 400s in pretty short order. And we're incredibly active in the market during that time period. And you need to be prepared for that again in 2026.
Christian, thanks so much. Appreciate it.
Thank you.
Coming up, we'll check back in with Brian Sozzi at Apollo Global Management and learn how annuities can maybe help pad your retirement portfolio so you don't outlive your savings. Stay tuned. You're watching Market Catalysts.
Welcome back to Market Catalyst. I'm Yahoo Finance Executive Editor Brian Sozzi. Back here at Apollo Global Management, there's a growing crisis in this country, and it has to do with the fact that we're all getting older. Me included, and I can't even believe it. The rapidly growing population plus a growing savings gap has sparked an urgent demand for guaranteed lifetime income. One tool to help close that gap are annuities. And here with me to go through the benefits of annuities is Mike Downing, Athene co-president. Mike, good to see you here. The stats around retirement they are absolutely mind-blowing. 40% expected increase in the number of people aged 65 and over in the next 25 years. Set the stage for us. How does that impact a business like Athene?
So from a business standpoint, it's just incredibly large demand for annuities today because of the growing retirement population. And it's inevitability. Everybody's getting older, the population's getting older, and not only are they getting older, they're living longer. And one of the challenges of traditional defined contribution savings is retirees or people planning for retirement running out of money. And that's where annuities can really come in and save the day, is help close the gap and actually create spending confidence at retirement.
As I look at your business, you mentioned people scared about running out of money. I mean, is that one of the biggest fears they have right now when you talk to retirees?
It is, and it's a real fear. It's well over half fear running out of money. It's about 64%. And it's a real fear because most savers have enough, just enough. And a market downturn could mean they don't have just enough. And to give you a sense as to the power of annuities, in terms of just a punchline, if you have $1 million nest egg, if you integrate that nest egg with annuities, that $1 million can feel like $1.5 million from a spending standpoint. So think about that in terms of spending power. So that's how annuities can come in and translate from nervous retirement to confident retirement, surviving versus thriving.
What mistakes do you still see retirees make?
Twofold. One is underspending, and so that's a fear of running out of money. And that's where annuities can really close the gap, is they can guarantee that lifetime income to the extent the actual assets run out. That's what insurance companies do, guarantee it. And the second is not early enough purchasing of annuities. Big benefit of annuities is tax deferral. Tax deferral is a young person's game, not an old person's game.
Why? How can you get young people to get excited about retirement planning? When I talk to 25-year-olds, they're like, retirement planning, I'm never going to get old.
So one of the great things about annuities, it makes it simple. Right, there's lots of different flavors. You can get a simple product that's just a guaranteed rate times a term. Think of it as like a CD, but instead of a CD, it's earning about 200 basis points more every year. Super simple, super easy to do. Second there's types of products that guarantee principal, but you still get equity upside, so you can still participate in the market, but guaranteed downside protection. But largely, it's peace of mind. So if you don't want to think about retirement, annuities can really help you get peace of mind and help deliver your retirement for you.
I mean, you talk to a lot of people. Do you get the sense sub-30-year-olds are planning well for their retirement, better than my generation? I'm an aging millennial.
Yeah, I would say it's a mix. And one of the things we're starting to see a younger group of buyers starting to buy annuities, and that's positive, but it needs to continue to go lower just to take advantage of that tax deferral.
There's, it's not lost on any of us. Today is Fed decision day in America. The Fed is likely to cut interest rates by 25 basis points, maybe follow up with one more early next year. Whatever the case is, what will lower rates mean to the retirement industry?
So people still have to save, right? And the rate environment is more or less, where do you put your money? And so regardless of rates, annuities are still a very valuable option because ultimately they'll still outperform CDs. They'll outperform CDs in any market. They will provide guaranteed downside protection in any market as opposed to the S&P. And so we see demand continuing to grow simply because of the growing aging population. And we've already seen it today. Rates are well off their peak highs. Demand is still incredibly strong for annuities.
Rates lower for longer. Do you think people are going to have to take more risk? Are they going to be forced into taking more risk if they want to earn returns? I mean, it's been easy the past 2 years. Dump your money in CD, earn what, 3 or 4%, make a good return, call it a day.
Yeah, I would say rates lower for longer. There's a temptation to take more risk. And again, that's where a really smart integrated annuity strategy. Think of, again, a typical saver that's going to get to about $1 million. 30 to 40% of that, put that in a nice basket of annuities, completely protects you from low rate risk as well as volatility risk.
We saw, this year President Trump sign an executive order for that could allow 401ks to invest in private equity. Is that the next big catalyst for this industry?
So 401ks is clearly, so by background, I'm a pension actuary. I watched the DB industry decline.
And I've talked to you before, like you are the man in this industry.
Yeah.
You're the man.
Watched it decline for 30 years. So what is DC? It's a $12.5 trillion pot of retirement money with no protection. It needs annuities inside of it. And the second thing it needs is differentiated returns. Right now, the way the DC market works is it's migrated to just all index funds, nothing uncorrelated with the S&P. So adding annuities, adding a sliver of private assets will help return and stabilize returns.
What has surprised you about markets this year?
Biggest surprise in markets this year has really been, in terms of 2025, is what we're seeing is the message that we've been giving out for a little while now, which is taking advantage of the tax deferral of annuities, is larger group of younger buyers deciding to look at annuities and buying annuities.
How will, you looking out over the next, you've been doing this for decades. I mean, I'm not calling you old. I mean, this is what you...
Seasoned.
This is what you do. How will retirement look different in 25 years?
I think the way it'll look in 25 years is I think you will cease to see distinction between DC, accumulation, and spending, and really see a complete integration between annuity, income protection, and defined contribution accumulation.
You help us understand, for those that are investors in Apollo, how does that relationship work with Apollo and Athene?
It's a powerful relationship, right? So what Apollo brings to the table is incredible investing skill. So as an insurance company, we need safe yield. So all of our assets need to be investment grade. We need to maintain our AM Best A+ rating. So we need that safe yield. Because of Apollo's massive origination team, they can generate safe yield, but and often take out the middleman. And that extra yield, that little bit of extra yield, can be passed on to the customer. And it allows Athene to be able to offer for comparative companies 25 to 50 basis points more in return.
There have been headwinds to this industry, and I think the company, y'all just give a presentation a couple weeks on this. You said, I believe, the headwinds for this industry are lessening. What have been those headwinds?
The headwinds historically for annuities is they've been a forgotten corner of the market, right? So the higher rate environment kind of popped and reawakened the market, and what we're seeing today is an acknowledgement of the value that annuities provide. Annuities today aren't the annuities of 30 years ago, and that's why we continue to see the high demand despite the decline in rates.
Why are annuities better than a CD?
Well, simple math is if you have a CD, CDs typically roll over about 20 years. Would you rather earn 2% or 4%? On average, it's 2% more every year on a annuity versus a CD. So think about that. You're saving for 20 years. You can earn with the same amount of savings 1.5 times as much money. To translate in that retirement gap, the total CD and money market's about 10 trillion. A lot of that just rolls to retirement. Let's assume that's just 20%. That's 2 trillion. Put that in annuities, that 2 trillion becomes 3 trillion of savings. That's $1 trillion closure of the retirement gap, which is 4 trillion today.
Lastly, Mike, the term retirement crisis gets tossed around a lot. Do you believe this country is in a retirement crisis, and how would you define something like that?
I would say it's in a spending crisis. There is a retirement crisis. There's a $4 trillion gap, and a lot of that gap is a result of the fact that there's savings that are accumulated that haven't been reprogrammed for spending. And that's where insurance can come in. That's the value that insurance and annuities can bring, is they can increase that savings that exist and make your 1 million portfolio feel like a $1.5 million portfolio from a spending standpoint.
One more. Why are you so passionate about this industry?
So I've watched.
Where did that even come from?
So I've watched the decline of pensions, right? The decline of lifetime guaranteed income protection, and we have an opportunity to fix it. It's a really once in a lifetime opportunity for the insurance industry to come together and close the gap. It's capital. We have the capital. We can provide the guarantees, and a company like Athene has $35 billion of capital to really make a big dent.
Well, good to see you again. Happy
Brian.
holidays. Michael Downing, Athene co-president. Good to see you. We'll talk to you soon.
Good to see you, Brian. Thanks.
All right, Julie, back over to you in the studio.
Thank you, Brian. Thanks to Michael also. And coming up, we're taking a look at some of today's top analyst calls and trending tickers. Stay tuned. You're watching Market Catalysts. Welcome back to Yahoo Finance. I'm Brooke Tapamo. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of EchoStar, Warby Parker, and Cracker Barrel. First up, let's take a look at satellite communications company EchoStar, because Morgan Stanley upgraded the stock to overweight from equal weight. The analyst believes it stands to benefit from rising competition among wireless carriers here in the U.S., and the stock also got a boost in recent days on news that SpaceX could be going public. The company had agreed to sell spectrum licenses to SpaceX for $2.6 billion last month. And even though the stock is up about more than 300% year to date, the analyst believes there's more room to run. On the street, there are 4 buy ratings, 5 holds, and no sell ratings on EchoStar. Next up, we're watching shares of Warby Parker, because that stock moving higher today after Citizens raised its rating on the stock to market outperform. The analyst said the upcoming release of those Google AI glasses on the Warby Parker platform represents a, quote, significant catalyst for the brand. That could drive estimates materially above the current consensus on the street. Now, the stock is still down about 50% from its IPO back in 2021, but there are 9 buy ratings and 6 hold ratings on the street.
Last up, we're watching shares of Cracker Barrel. That stock has seen quite a slide over the past few months, and now Wall Street is resetting its expectations here. Truist, Gordon Haskett, and Piper Sandler all cut their price target on the stock. Gordon Haskett cutting its price target as low as $25 per share. Now, keep in mind the average price target on the street right now is at $33. And this comes after the company cut its 2026 sales forecast following the recent backlash the restaurant chain received over that logo change earlier this year. The company has since walked back and restored its old logo, but shares are down more than 50% year to date. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching GameStop, Carvana, and Intel. First up, GameStop. The video game retailer reported net sales for the third quarter that declined nearly 5% year over year. However, its operating income did rise in the quarter compared to a loss during the same time last year. The company also saw growth in its collectibles business. But as a reminder, GameStop's also trying to get into the digital asset treasury space. The retailer's Bitcoin holdings were valued at $519 million at the close of the third quarter. The shares are down 5.5%. Next up is Carvana, the car retailer on track for its longest streak of gains ever. The stock is now poised to close higher for 12 straight days, and those gains come as the company prepares to join the S&P 500. That sent the shares up about 15% in the last 3 trading sessions alone. Carvana stock last saw a record 11 straight days of gains back in 2019. And Intel, those shares are taking a hit after lawsuits accused the company, along with AMD and Texas Instruments, of failing to keep their technology out of the hands of Russian missiles. The lawsuit alleges the company's demonstrated, quote, willful ignorance as third parties resold restricted chips to Russia to power drones and missiles. The lawsuits were filed on behalf of dozens of Ukrainian civilians, and they cite 5 attacks between 2023 and 2025 that killed dozens of people. Coming up, SpaceX seeking a sky-high valuation, what investors can expect when the company makes its public debut. That's next. Elon Musk's SpaceX reportedly moving ahead with plans for an initial public offering in 2026. According to Bloomberg, the space company would seek to raise significantly more than $30 billion, targeting a valuation of about $1.5 trillion. Yahoo Finance's Josh Lipton spoke to Lisa Rich, founder and COO of Explore and founder of Hemisphere Ventures, about all of this.
Lisa, it is great to see you. So SpaceX is moving ahead with plans for this IPO. It would seek to raise significantly more than $30 billion. This is according to Bloomberg, citing sources. Pursuing a listing as soon as mid to late 2026. I'm curious, Lisa, how, if this happens, would you expect public market investors to perhaps react and respond to that IPO? And what more broadly, Lisa, would such an IPO maybe signal to you about just the space economy and industry?
Thank you, Josh. Thank you for having me, and pleased to comment on this exciting news for SpaceX. This is a continuum of capabilities with a company that's proven itself to be sustainable, resilient, and reliable, which is what the space industry needs. Launch is a very difficult thing. There have been hundreds of competitors in launch. No one has done what SpaceX has done with a cadence of launch that companies can rely on. In fact, my own company, Explore, got to space on a Falcon 9 last December, and it was just a phenomenal launch, and everything went as planned. That's what the investors need to know. That's what the companies that are their clients that need to launch their high capability hardware and software on satellites need to know. This is, as I said, a continuum of capability for SpaceX. Launches first, but with Falcon 9, Starship is coming online. And what they're enabling with Starship is phenomenal. When you go into the Starship rocket at their SpaceX Starbase, as I have, you go inside of it and you see the capacity that they can include on a single launch. So what does this do? This reduces the cost of launch, which is really important to increase how much we can have, how much mass we can can get to space and how many companies can benefit from the value of sending satellites to space. So that Pez dispenser that they created, where they can just pop off payloads when they get Starship in space, we can't wait to be a part of that.
I'm curious, Lisa, because you've invested in something like 30 plus space companies. So where are we in sort of the space economy cycle, early stage versus actual commercialization? Where are we, and where does, in your opinion, sort of SpaceX fit in there?
Right, because our companies that have exited, Voyager most recently, they're still early days, right? But the space economy is robust, and especially with the government support, as you've done your shows on showing the importance of the military component for space, there is a lot of work to be done with fueling the AI revolution. So as we think about satellites that go to space and what do they do once they get to space, typically it's either comms, communications capabilities, or it's collecting data. So as my company does, we're collecting data, and that data is going to fuel the AI revolution. They need it as it is unattainable otherwise. It is uncorrupt, pure scientific, autonomously collected data from satellites that will fuel LLMs, MLAs, and the AI applications that all of the AI companies like Palantir, Anduril, et cetera, are working on.
How, Lisa, has the regulatory backdrop evolved for the U.S. space economy over the many years you've been investing here? How has it evolved? Have you seen, by the way, significant changes since Trump took office?
Absolutely. I just got back from DC and was just overjoyed with the appointment of Taylor Jordan to the U.S. Department of Space Commerce. One of the big moves they're making is they're taking the Department of Space Commerce outside of NOAA, out from underneath NOAA, and having it as an independent department is really important. So that's happening, and Howard Lutnick is a great supporter of space, as I understand it. So they have some investment that they're going to be making. They already have really kind of changed the parameters around how early stage companies can benefit and have help from the government with the Office of Strategic Capital that last year issued an opportunity to obtain $900 million in loans for early stage companies that were sending satellites to space. They expect to expand this, I believe, because companies were promised that that was just stage one, and we're going to go on from there. So I'm trusting this administration, especially with its focus on international relationships and making sure that the U.S. has primacy in space, that we need to work with our allies, and we need to enable U.S. commercial companies to strive and thrive. And how do we do that? We do need the government stepping in when needed, especially for international relationships, because it can get very complex for especially early stage commercial companies. These are not companies with thousands of employees and a team of lawyers or foreign relations experts or what have you, what you need for international. So we need resources, and the U.S. Commerce Department and their associates like NTIA are looking to help.
Final question, Lisa. We often talk about key man risk when it comes to Musk. You know this, of course. And I'm just curious, as a SpaceX investor, how you think about that, how you think about Musk's centrality to this company.
Well, is there a key woman risk, by the way? Because I was seeing that Gwen Shotwell twice was selected as like the award of the year for innovator of the year as like one of the most outstanding operators and executives in the space industry. So when you think about continuity, you remember we were all worried about Disney when Iger left and, what's going to happen, or when Steve Jobs died. But in this case, I think you've got other people behind the helm. I'm very close with some of their top folks that run launch, for example, and have other purposes at the company. They have the most stellar team in the world. SpaceX has been able to attract the top 1% of employees, bar none. I mean, I wish I had their applicants, right? So I'm not worried.
Lisa, great to have you on the show today. Thanks so much for your time and your perspective. Appreciate it.
Thank you.
Coming up, why AI isn't just boosting tech stocks, but a whole category of ETFs. Thematic ETFs are making a comeback, with total assets under management growing from $89 billion in June to $118 billion in November. My next guest says a big contributor, of course, is the AI boom. Maybe not a surprise. Joining me now in studio is John Mayer, JP Morgan Asset Management Chief ETF Strategist, for this week's ETF report brought to you by Invesco QQQ. Thanks for being here, John.
Thanks for having me.
So thematic ETFs, what has been the sort of waxing and waning of them over the past few years, I guess?
Yeah, for a while they were just certainly in vogue in different areas like robotics and electric vehicles, but you've seen a convergence on the theme into AI. And AI is really touching many different areas because AI really can impact robotics, electric vehicles, and things like that. So at JP Morgan, we have an ETF that focuses on technology more broadly. The ticker is JTEK, JTEK. And it focuses on adoption and enablement in technology, which could be broader than technology. It touches communication services, consumer discretionary.
You've got some healthcare in there, I think, too. So
a little bit of healthcare.
So I guess it's companies that are using AI, no matter what sector they're in.
Yeah, the AI and just technology in general obviously improves efficiencies. And if you have a bottoms-up research team that focuses on different aspects of companies, valuation, earnings, we think that's the right way to approach, to kind of look at a broad-based segment of companies and how those companies are going to benefit improvement in efficiencies.
Yeah, so it makes sense in that lens that thematic ETFs are coming back, not just that one, but in general. We've also seen this sort of growing boom in actively managed ETFs, which is a pretty big change for the industry, it feels like, sort of putting a strategy in an ETF wrapper. It's still relatively small, but it has been growing a lot. What do you think has been driving that?
Well, the adoption of actively managed ETFs really started in 2019. 85% of all ETFs that have been issued since this year have been actively managed. So there's about $1.3 trillion of actively managed ETFs. So it's about 10-12% of the overall marketplace, but it's been 35% of the flows this year.
Wow.
So I think what's happening is that a lot of these funds have 3- and 5-year track records, are getting on platforms that investors are able to kind of take off the shelf. And the ETF structure has so many different benefits just overall. And that's really being realized by the end investor.
I know it's a very diverse group, but do active ETFs perform better than passive ETFs?
Well, it really depends on the category.
Right, yeah,
right?
I guess I keep trying to lump them all together. It doesn't quite work.
So it's there's 4,500 different ETFs. For fixed income, for example, fixed income is a category that historically in the ETF wrapper has been passive. But overall, it's an active market. 70% of all assets in fixed income, no matter what structure, have been active. Now, when utilized inside the ETF structure and then add on the layer of active, for the most part, most of our ETFs outperform the ag. J-bond, for example, JBND, which is an intermediate core bond portfolio, has lower volatility than the ag, includes more sectors than the ag, like the securitized market, and does better than the ag. So why not choose an active manager?
Right.
There's like 3.5 million individual securities in the fixed income area. It's very hard to parse through and decide which securities you should include in your own portfolio. Outsourcing that to somebody else, it's a great way to go.
What kind of adoption have we seen of ETFs within 401ks? Because that seems like it's sort of the final frontier, if you will.
Not much.
Yeah. There's some regulatory reasons for that, right?
Yeah. First of all, if you think about regular money goes into 401k plans and things like that, most people don't trade their 401k plan, so there's not as much a reason. to have ETFs inside 401k plans, but there certainly are some 401k plans.
You can save money in some cases, right? By
less
having something in an ETF wrapper instead of a mutual fund wrapper, right?
Yeah, they're less expensive, more cost effective. And certain platforms do, but it's not, there hasn't been broad-based adoption yet. I think that will change over time because the ETF structure, from our perspective and from the market's perspective, it's just a better structure than the mutual fund structure.
In your ETF world, as you look to 2026, what are you most excited about, or what's the next innovation coming, or what are you looking for next year?
So I expect to see more actively managed ETFs, just like we have seen in the past. I expect to see, in terms of diversification, as you build your portfolios, the ETF landscape is going to look more like the mutual fund landscape has looked. Large cap growth, large cap value, intermediate core bond plus, and derivative income. You're going to see more assets go into those categories because of the realization of the ETF structure being less expensive, as you mentioned, and there's more benefits. The tax efficiency of ETFs, which certainly is a huge benefit, is probably the superpower of the ETF and has really driven adoption over time. So I think you're going to see assets more flow into those more traditional categories. It's already happening. It'll continue through 2026.
We've also seen a lot of non-traditional types of ETFs.
Yeah.
I mean, we have single stock ETFs. We have 1 million leveraged ETFs now. Do you think that is increasing risk in the system, that we are seeing those more exotic instruments?
It's still some of those assets are still a relatively small portion of the overall marketplace. So I don't think it's going to add risk. It does add the count of ETFs. So often we hear that there's more ETFs than there are stocks. So what? There's more mutual funds than there are stocks. And there are certain categories that folks who like meme stocks and things like that will play those categories. But for the more core traditional investor, they're going to stay the same. Invest in those moderately aggressive type of portfolios.
Right.
Have a diversified portfolio, and you have these great building blocks, and those building blocks are ETFs.
John, thanks for coming in.
Thanks for having me.
Appreciate it. Coming up in the next hour of Market Catalyst, we'll have more market coverage and talk about whether there is an AI bubble. My next guest is skeptical. We'll be right back. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check at the markets, which are not doing a heck of a lot ahead of the Fed this afternoon. A little bit more movement than we saw earlier. The Nasdaq is now down about 0.5%. The S&P 500 treading some water in the middle, going downward. The Dow right now is up 103 points. But of course, we are all waiting for 2 p.m. when we get the Fed rate decision, and then 2:30 when we hear from Jay Powell. So ahead of that, seeing that mixed picture. In the meantime, we've got the AI trade, of course, facing increasing scrutiny heading into 2026. My next guest says the AI bubble talk is ridiculous. Joining me now, Brian Belski, Humilis Investment Strategy CEO and Chief Investment Officer.
Who wrote that? Ridiculous. Oh, that was me.
Oh, it was you, wasn't it?
Oh my gosh.
Okay.
Julie, thank you so much for having me.
Yeah, it's good to have you. Why is it ridiculous, the AI bubble talk?
Just because prices go up doesn't mean it's a bubble. And I think bubble is one of the most overused words in financial history.
So what is a bubble then? What would define a bubble?
A bubble means that there's froth, right, everywhere. And from our lens, you can't get a bubble until everyone's making money. And you're going to say, well, everybody made money last year. Really? No.
The dot-com bubble, everyone wasn't making money.
Well, if you look at, if you
when
go
you say
back,
everyone making money, do you mean people in the market or do you mean the companies?
I'm talking companies, but more importantly, quote unquote, the man. And what I mean by that is if you go back and look at the 1990s, and the average private wealth account was 90% stocks, and a very high percentage of those stocks were tech stocks. Okay, so private wealth got locked out or just crushed when the dot-com bubble actually did burst. But so did institutions. It changed the way that we were running money because institutions started to doubt analysts and bankers, and that's the advent, but really I would say the focus on quant investing and modeling. Okay,
right.
Let's go back. Who's the man? The man are investment banks. If you think about what's happening in the AI world right now, It's very select on where the deals are getting done. Back in the late 90s, you had these goofy, quote unquote, deals where companies were buying other companies for stock that didn't have any value, right? So the investment banks were getting rich, the brokers were getting rich, the companies were getting rich. When everybody's getting rich, that's a bubble. Oh, by the way, happened in 2007, 2008 in financial services as well. The banks were making money, the brokerage dealers were making money, the mortgage bankers were making money. And so at the end of the day, we need to see a lot more quote unquote froth in AI. And I think what's making this not a bubble as well is a theme that I think is going to take place and manifest itself even more so in 2026, and it's this theme of dispersion. A lot of people start talking about dispersion, but dispersion is about stock picking. Just look at the Magnificent Seven. I'm going to be brash and make a prediction. I think the Magnificent Seven a year from now, those 7 companies will be different companies. They
already are different companies.
I know, but we're going to have even more so. And
we shouldn't even be calling it them. I mean, we should get rid of Magnificent Seven already. They have already dispersed, if you will.
They have, and if you just look at the last month or so,
Yeah.
look at the last month in terms of fundamental realities of Meta versus Google, right?
And Tesla is like
And
over
Tesla,
here.
yeah, Tesla's not even a technology company; it's a consumer discretionary company. So then you got to go back: is why consumer discretionary been doing so well? But relative, if you take it if you look under the hood, you got a lot of companies in consumer discretionary not doing well. So because it's the sector is skewed by Amazon and Tesla. Some would say Amazon's future is about AWS, not the retail business.
Right.
So I mean, this is all about stock picking and fundamental analysis. But at the end of the day, I think next year is going to be about picking stocks within sectors with high standard deviations of returns and fundamentals, meaning you're going to have to pick stocks, not the sector, and not broader index ETFs.
Okay, so what stocks do you pick, or what screen you apply to figure out what's going to do the best?
So it's a great question. It's a bit of a trap because we don't run money on screens. We run money on fundamentals. So what we do for years now, I'm not going to tell you how long I'm doing it, but you know how long. So running money for over 20, but in the business for 36, is that if you look at the bottoms up and marry the top down. Now I'm not talking about economic variables or the Fed today. I'm talking about top-down, broader
Okay,
models.
I'm gonna pause you for just one second. For people who are not steeped in finance speak, top-down means you look at the macroeconomic environment, you look at what the Fed is doing, and you make investment decisions. Bottoms up means you look at company by company what their earnings look like and make decisions that way. Is that a fair way to describe the two?
But on the top-down side, the way we look at it is we look at broader models that encompass the entire market, okay, from a fundamental perspective, looking at valuation, earnings growth, operating performance, and performance. What's operating performance? The return structures, return on equity, return on assets, return on invested capital of the market sectors and industries. We have these models, and then we take a look at why do I want to buy Google in communication services in the S&P 500 relative to why do I want to buy Reddit in the communication services sector in the S&P 1000. So we do that type of work and balance that out. I think you're going to want to be more balanced on the bottoms up. You're still going to look at where the valuations are. And obviously macro data, economic data, ISM, PPI is all lagged, but you have to incorporate that from a peripheral vision. But I think it's going to be bottoms up stock picking. You can run a screen in terms of how this stock is relative value or earnings growth compared to the market, but you're not going to run a multi-factor, I don't believe a multi-factor quant model, because sometimes with that, a lot of times with that, it's analysis paralysis and it's too much information. What's happened in Wall Street, going back to the very beginning about the bubble thing in 99, 2000, Wall Street lost credibility in terms of analysts and bankers because everything was going to go up, you throw a dart, right? So that was the advent and really focus on quant. And what happened was people became too formulaic because they were so afraid to be wrong, they don't want to be right. It's now time to believe in America and to believe in companies again and believe how awesome they are. The United States of America has the best companies in the world. We've proved it over the last 10 or 12 years. We still believe that we're in the midst of a 25-year secular bull market that started in 2009 and has another 10 years to go. We believe the next 10 years is going to be very different than the last 10 years, though.
Okay, so just one quick pause. So you think that the international outperformance this year was an aberration or a blip or just a temporary disconnect before a resumption of U.S. stocks performing better on a relative basis?
We believe, well, first of all, those stocks were cheap for a reason because fundamentally they've underperformed for a long time. And they came back pretty strongly because most of that was driven through fear and loathing in the United States, what was happening with the policies of the President of the United States and what's going on with tariffs. So money left and they chased it elsewhere. But if you look going forward, you get what you pay for, right? We get what you pay for in the United States in terms of the index itself and the diversified nature of our economy, world's largest economy, and the strength of their economy. Our economy strengthened in the last 10 years relative to China has weakened the last 10 years. Just to think about that. In terms of the other international markets, fantastic. You're going to have these types of near-term 1 or 2 year outperformance, but from a secular perspective, it's still best to be in the United States. So I always live by the old adage of Warren Buffett, don't buy anything unless you can reach out and touch it. I want to be able to understand and see the companies that I invest in relative to looking at something international that doesn't have the wherewithal and consistency and fundamentals that the United States companies
Okay, so to come back to what you said, if you look a year from now or a decade from now, what are going to be the winners? And how do you figure that out?
Well, we figure that out by looking at good old-fashioned things like balance sheet consistency, cash flow consistency, earnings consistency. What's the addressable market of that company? What's their proven track record of managing that business? Now, for instance, what Google did this year, I don't think people are talking about this enough. They brought back former CEOs and their founders to kind of reposition the company. They made strategic alliances with Apple, right? Keep your friends closer, your enemies closer. I think the company was sold off too soon in April when everybody decided that ChatGPT was going to take over the world and we weren't going to ever search again. To me, that was ridiculous. So that provided an opportunity. And then you take a look at the company itself with respect to what's going on with AI, but also its YouTube business. Its YouTube business is bigger than Netflix.
Yeah.
And one of my favorite sectors for the last decade has been communication services because of the cash, content, and consolidation. That's been our theme for 10 years. So we think that's going to continue. So Google, we think, will be a major winner going forward. We think Microsoft will continue to be a major winner going forward because the company has demonstrated from a cash flow and earnings perspective that it can get through this, but also it has the best technology, the best management team in terms of where they're going and with respect to having a track record in this. Amazon's another one because of their other business ventures, but also what they've done with AWS. Apple has more cash on the balance sheet than several international countries that people want to buy.
And you're not worried about some of the management changes and shakeups they've had there recently in terms of the AI chief leaving and some of those changes?
I'm not, because at the end of the day, that's what's really going to be driving things going forward in terms of the overall management. They'll find the right people to take care of that stuff. And it's not all about AI. It's some of their other legacy businesses as well. They're going to do very well.
So that's the Magnificent Four then.
The Magnificent
you,
Four.
I
Well,
guess.
I mean,
or do you not how do you feel about NVIDIA?
We're owners of NVIDIA. We've owned NVIDIA in terms of our assets under advisement that we ran in our prior place that we'll continue to look at going forward since 2017, 2018. It's a stock that I also owned when it was a mid-cap name in the mid-2000s, so very familiar with Jensen as a manager, as a person, as a man in terms of how he's run that company. Amazing as a visionary. So at 8% or 7-8% of the S&P, it's exceedingly difficult to be overweight that name. So we've been, and on record in our published reports, we've been more neutral to underweight just because it's difficult. But I think we can make up our tracking error in being overweight some of those other names, and then also overlaying, believing in Oracle and what's happening there longer term, and believing in names like Palo Alto. And so that's where we've been, and I think that's where we're going to continue to be.
It's so nice to be able to talk specific stocks with
Isn't
you.
that great? It's fun.
Yes, this is a change. Thanks so much, Brian, for
Thank you
coming
so much
in.
for
I
having
appreciate it. Coming up, we're going to explore why the rate of AI adoption by U.S. companies flattened last month. Stay tuned. You're watching Market Catalysts. The rate at which businesses adopted AI platforms rose sharply throughout 2025 as the capabilities of those platforms increased, and then that adoption trend leveled off last month. Ramp is the 8th largest private company by valuation, develops spending platforms to help businesses spend efficiently. That's according to Yahoo Finance's private markets data. And Ramp has put out its AI index report. The economist there, Eric Karazian, is joining me right now. Thanks so much for being here.
Thank you, Julie, for having me.
So this is so interesting that you guys even have this. So you're basically looking at clients, you're looking at spend data, and you're looking at what they're spending on and at what rate. So what what happened last month?
Yeah, well, the unique thing about ramp data is it comes from our corporate card and bill pay platform. So this isn't a survey that asks businesses what they're spending on. We're looking at actual transactions that are happening, we're looking at receipts and bills that are uploaded to our platform. That's what's unique about the result. We've been tracking this ever since about 2023 when the AI models were introduced at scale. And over the last year, we saw a significant run-up in AI adoption rates. About 25% of businesses on our platform were already paying one of the major model companies at the start of the year. That's now risen to about 45%. So a significant run-up in 2025. What we're concerned about now is that that adoption rate has now flatlined. It's sat around 45% over the last couple months.
And why is that happening, do you think?
Well, it could be for a couple of reasons. People are talking about an AI bubble. I don't necessarily think we're going to see an AI bubble pop anytime soon, because although adoption rates are starting to slow down, we are seeing the intensity of that adoption start to increase. So contract sizes are getting bigger. The typical AI contract was about 20 in 2023 was about 40K. Companies are more likely nowadays to sign significantly larger AI contracts. We project they'll hit about $1 million on average next year. So companies are leaving the sort of experimental phase of, hey, which AI software should I buy? They're also more likely to subscribe to more than one model nowadays. So although we're seeing the slowdown in adoption, I wouldn't necessarily say that we're seeing a slowdown in the development and pace of the industry.
Okay, and just to be clear, when we're talking about adoption, are we talking about the amount spent? Are we talking about the number of companies who have this spent? Like, what exactly are we measuring?
The number of companies using AI.
Okay.
That's started to flatline. But even that is hard to measure, because we've also seen an increasing number of businesses start to switch to what we might call like an embedded tool. So companies like Google and Microsoft are now integrating AI for free into a lot of their enterprise workspace products. So Google started to integrate Gemini for free. If you have a Google Workspace subscription, you also have access to Gemini Pro. We do know anecdotally from our platform and the businesses that we talk to that a significant number of businesses are starting to use those free services already integrated into the software they already buy.
And what about native LLMs, right? Because some of the larger companies that have the ability to do that are probably developing their own also. Is it in addition to? Is it instead of? How is that looking?
It tends to be less common nowadays. There was a fad about whether or not companies should start developing their own LLMs given the success of companies like OpenAI and Anthropic. In part, it's because of the success of companies like OpenAI and Anthropic that larger companies have started to pull back from those efforts. They found that the pace of development for these models is so fast that they just can't keep up, and it doesn't really make sense as an investment nowadays. So companies are very likely to just buy the models directly from OpenAI and Anthropic. And the companies themselves, the model companies, have started to adjust for that enterprise demand and offer contract deals that are specifically geared toward the security that an enterprise
Got
needs.
it. We talk a lot here about the AI arms race and the competition between the various models. You mentioned that a lot of companies are using more than one model. So how is that race sort of showing up?
I don't think people have really caught up to how competitive this software market is. It's not like the software market you might be used to if you've ever bought software at a company, where you might put out an RFP, request for proposals, and get quotes from multiple vendors and then maybe stick on that contract for like 5 to 10 years. This software market doesn't work that way. The level of development that is happening, the pace at which it's happening, is fairly unheard of, in that you will have a new upstart AI company, not necessarily a major model company, but sort of a startup verticalized solution that can very quickly unseat a large incumbent just by the fact that it has a rapid run-up in adoption and solid product market fit. And so companies have to adjust for that. Purchasing plans have to adjust for the fact that you can't just have like an AI pilot program for 2 weeks and then assume that the vendor you find is the vendor you'll stick with. You really do have to stay on top of this market, make sure that you are monitoring the different types of models that are coming out and monitoring the different kinds of software solutions that make best sense for your business.
And are we seeing a lot of then price competitive, not just based on the quality of the technology and the model, but also I would imagine there is some price competition going on?
It's an extremely competitive market. I mean, we saw a lot of dynamism in the market, especially when a player like Google started to offer its services for free for any workspace company. Now, again, there's some wrinkles to that kind of analysis too. OpenAI is actually at the most businesses. It has the highest adoption rate, so more businesses use OpenAI than use any other AI software tool. Because of that, it has this almost lead in distribution and is almost seen as this default selection for not just consumers in the way that you and I might download the ChatGPT app, but for businesses getting an enterprise software solution.
A quick question about Gemini, because it is free. How do you measure then the adoption of Gemini? If you're measuring spend, how do you capture that?
Well, we know that businesses can also use the more comprehensive tooling that Google offers through Google Cloud. So we can see the dollars spent on that. These are what we might call sort of the API spend tools. And otherwise, it's a challenge for a lot of researchers. I mean, the census specifically as well has its own measurement that tracks the share of businesses that are using AI software. And just this week updated its question because it found that the question it had originally written for its survey was just not effectively capturing the share of AI adoption that was happening. They're genuinely very difficult things to measure, especially when there's a lot of hope around AI being the technology that's going to launch us into a next wave of US productivity growth. And we haven't necessarily seen that in the aggregate economic statistics yet. And so you have economists like me and other researchers who are trying to find the data sets that we can use that might inform, hey, where's our economy going? Are businesses getting any ROI from this? And if they are, how are the best businesses implementing these tools into their tech stack?
And which, we don't have much time left, but what the ROI question to me is the question, more than the bubble question, yada yada. The ROI question is the question. So what are you finding in your research in terms of what kind of return on investment they're getting from this spend?
I think it's really early in the product development ecosystem, but I'll say that even then we've found examples of companies that have figured it out. I was talking to a CFO of a large public tech company who told me that they have now automated a double-digit percentage of customer service inquiries because they've implemented AI effectively. Now that is a fairly tech-forward company that I'm talking about, but I would use that company as an example of where other businesses are likely to go. Maybe not in the next year, but I think probably in the next 10 years we'll see an increasing share of businesses start to shift to that kind of paradigm.
Really interesting. All right, thanks so much for being here.
Thank you for having me.
Appreciate it. We got much more markets action coming up. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's get a quick check of the latest market action. We're about 2 hours into today's trading session. As everyone, all investors await the key Fed decision meeting coming out at 2 p.m. Eastern. We are seeing a mixed picture on the street 2 hours in. The Dow holding on to some momentum that it gained after the open, up about 0.5%. The NASDAQ seeing a downward momentum, down about 0.2%, whereas the S&P 500 still hovering around those record highs, up about 0.1%. And if we take a closer look, year to date, still moving higher as we make our way towards the end of the year, up about 16% after seeing a bit of a volatile past few months. Now we're continuing momentum as we make our way towards that Fed meeting at 2 p.m. I do want to scroll down a bit and take a look at what the 30-year and 10-year T-note are doing, because we haven't seen them return to the highest levels since September. Taking a look at the 10-year T-note, what we've seen in intraday trading is that down about 2 basis points to 4.17%, and the 30-year yield also moving lower, down about 3 basis points to 4.8%. And if you take a look over the past few months, let's say year to date, these once again are the highest levels that we've seen since September. And you could see in November we have seen the 30-year T-bond yield moving higher, and so we'll definitely keep a close eye on that. But I do want to take a look at Bitcoin, because we have seen Bitcoin pull back a bit in cryptocurrencies across the board. We are seeing mostly red, with Ethereum moving higher this morning, but Bitcoin falling below that 94,500 thresholds after quite a few months of volatility for cryptocurrency. Over the past 6 months, Bitcoin down more than 16%, and we're seeing that extend as investors await the Fed rates decision this afternoon, down about 1.3% 2 hours into today's trading session. Taking a look at the NASDAQ, we do have some big moves there. Bit of a volatile picture with Nvidia, Microsoft, Meta, and Broadcom moving lower, but we are seeing companies like PepsiCo move higher after JP Morgan upgraded its rating on the stock to overweight. Another bigger mover here in this early innings is DoorDash. This stock seeing a downward momentum, down about 4% in intraday trading after Amazon announced that it will be expanding its grocery deliveries. You can see this company has been doing well, and now that 4% decline hitting today. Also taking taking a look at the Dow. Other movers that we're seeing include from Nike. Nike seeing a nice pop today after Guggenheim initiated coverage on the stock with a buy rating, up about 2.7% in intraday trading, and a bit of a mostly in the green for the Dow, and that's why we're seeing the Dow moving higher this morning. Once again, the Dow up about 0.5%, and that's again, it's the S&P 500 mostly flat, and the Nasdaq down about 0.2% as we await that key Fed rate decision at 2 p.m. Eastern. Keep it right here on Yahoo Finance. We'll be tracking all the market moves as well as that key Fed decision throughout the session today.
Now time for some of today's trending tickers. We are watching Nextdoor, Our Environment, and Photronics. First up is Nextdoor. The social network for neighborhoods is surging as hedge fund manager Eric Jackson targets the stock. Jackson remembers the fund manager who sparked a rally in Opendoor this year and is best known for his bet on Carvana. Jackson said the company was one of the most misunderstood platforms in the market. He adds it has yet to recognize its potential in artificial intelligence. Next up, AeroVironment, the drone maker, cut its earnings outlook for the year and for the prior quarter. It posted gross margins of 22%, which were down from 39% a year earlier. The outlook was hurt by the U.S. government shutdown and its transition to new operational systems. Its CFO said due to the new system upgrade, the company experienced some operational inefficiencies and one-time costs. And finally, Photronics, shares of the semiconductor company surging by the most since 2009 after its earnings. The company forecast revenue for the first quarter that beat the average analyst estimate. Photronics' fourth quarter results also topped expectations. The company makes so-called photomasks. They're devices for laying out circuit designs on semiconductor wafers. Its CEO cited strength in the U.S. market and its expansion into South Korea. Coming up, much more markets action. You're watching Market Catalysts. 2025 may be coming to a close, but the U.S. government still has a robust list of pending decisions, many of which are likely to spill into the new year. Yahoo Finance's Josh Lipton spoke to Henrietta Trey's Veda Partners Director of Economic Policy about which ones investors should be keeping a close eye on.
Henrietta, always good to see you. So let's start on what you call, Henrietta, your most controversial call. That seems like a good place. Why are you assigning, Henrietta, 65% odds now that the Supreme Court does strike down the Trump tariffs? What is sort of the core legal reasoning you see here?
It's got to be Article 1, Section 8 of the Constitution. You know, we fought the Revolutionary War over it. If you're going to tax Americans, certainly to the tune of $3 trillion over a decade, which is what CBO estimates the president's IEEPA tariffs are going to bring in, then that has to start with Congress. And so the oral arguments that happened in the Supreme Court a couple of weeks ago were 3 hours of basically circling around that debate. Is a tariff a tax? And the reality is that the Court of International Trade and the Federal Circuit Court of Appeals both found that these are, in fact, taxes, and they need to be enacted by Congress. The president is, not a king. He doesn't have the authority to do that. Exactly why we fought the British. So that's the crux of it. I think I'm in pretty good standing amongst my peers and thinking that the Supreme Court is going to side with the other two lower courts. That's not really the super controversial part of my call. I think the most controversial part is that I don't think the president has the leeway to reinstate these tariffs through other means in what would otherwise be basically Liberation Day 2.0. We saw the market tank that day. Businesses struggle for 6 months to adapt to tariff uncertainty. We're basically asking the president to do all that all over again in an election year, which is going to be where he would be doing it, January, February of next year. I think that's a bridge too far. I think the U.S. consumers too concerned with affordability. Inflation's still hot at 3%. The Fed hasn't been able to get it down. Unemployment is up. I don't think that we're in a place that we were when the president, had a mandate fresh off of the election in April of 2025.
So, Henrietta, let's say you're right about the Supreme Court. When do you think, Henrietta, that decision could come? What do you think a timeline could look like?
Man, that's the key question. I mean, it could come as early as tomorrow. Any time in the next couple of days, the next 10 days, I would say, please don't take a vacation if you're an investor right now. This is a once-in-a-lifetime binary event on, again, $3 trillion worth of stuff. So the possibility of the Supreme Court ruling this month is obviously very top of mind for the president. He was sending out social media posts about these tariffs in the Supreme Court case at 3 o'clock this morning. Jameson Greer, the USTR, expects that it'll come in December. So I can't say that there's any sort of read through to the black box that is the Supreme Court, but this is an emergency case. Both the Court of International Trade and the Court of Appeals decided their 2 cases from start to finish within 35 days. So that points to a sort of before year end, maybe even before the end of next week, announcements from the Supreme Court. It could take longer, but the next 10 days are not to be taken a vacation.
Henrietta, I'm curious how you think the markets might respond and react if the court did step in and say, yes, the Trump tariffs are illegal.
It's going to be different for 2 sides of the market. The bond market is not going to like it. The bond market's been counting on that $3 trillion in revenue since the One Big Beautiful Bill passed. That was a substantially deficit increasing tax bill. Our deficit is at $38 trillion. Bond markets are very focused on that revenue, and they like it. The equities markets are a horse of a different color. If you are a Nike, Under Armour, Walmart, Target, Home Depot, you're going to be stoked to see these tariffs come off, and especially if they stay off. So it's really going to be differentiated. And I think that it's important for investors to get very nuanced and understand that there's a difference between China and India and, say, Japan and the UK. If we take reciprocal tariffs off as a available tool, my expectation is that the president will not reinstate tariffs on Japan or the UK or even South Korea that the way that they are right now, even in some of the tacit agreements that they have. But China already has an existing Section 301 authority where you can quickly just replace the IEEPA tariffs with an authority that you already have and just hike the rate. There's a lot of countries to go through. Brazil, obviously, would be huge. Canada, Mexico. The list is long. All of Southeast Asia, Vietnam, the Philippines. So you really got to get granular. But it's going to be different for each type of tariff and each type of market.
Switching gears, Henrietta, I thought this was interesting as well. On ACA subsidies, your odds of extension fell. They went from 65%. Now they're at 25%. What changed there?
Yeah, we really were expecting for leadership to step in and say that in the economy where healthcare costs and housing costs are driving this narrative around affordability and really hampering the Republican conference, as we saw for the last couple of major elections in New Jersey, Virginia, and more recently in Tennessee, you could very easily pass, a 1-year, 2-year extension of ACA subsidies, and it's not an insignificant hit. For individuals over the age of 60, this is $920 per year. About 4 million people are going to be kicked off of healthcare exchanges. 22 million people would be impacted. So as you go into an election year, it's pretty routine for members to just throw money at the problem and offer short-term can kicks. But what we've seen from the leadership in the last couple of weeks since the government reopened is just a complete lack of unifying around a bipartisan consensus. And that was unexpected, again, given that affordability narrative and the fact that 2026 is a midterm election cycle. So now that we're unlikely to see the ACA subsidies extended, the odds of a government shutdown happening next year also rise just slightly from 20%, which is very high for me to start off with, to 25%, which would start on February 1st. So a lot of interplay for the first quarter of next year, and DC is going to be in a crunch.
Finally, Henrietta, President Trump is scheduled to speak here shortly, a couple hours. I'm curious, this issue of affordability and economic anxiety, now a key political issue, and I'm just curious to get your take on how Trump is tackling that issue. What do you make of his tactics, his strategy, his game plan there?
Yeah, one of the hardest things that the president has to do in an election cycle is try to pass legislation. And as we started off by saying, he doesn't have the power to spend money. So he can't just issue a $2,000 tariff rebate check. He has to go through Congress. So one of the easiest things that the president could do would be to, let the Supreme Court take these tariffs off. It's an $1,800 per household benefit if you take the tariffs off annually. So that is something that the president could do, but it otherwise has to all be through executive action. Getting another big partisan bill through Congress next year is going to be a bridge too far. My odds are, at the highest 30% that the Republican conference will be able to do that, especially when you see about 24 Republicans on the House side retiring instead of running again. So the president is between a rock and a hard place on this. And I think the Supreme Court would be giving him a big out if they said, hey, you just can't put these tariffs on anymore. That would immediately alleviate, the price pressures that consumers are seeing at the grocery store over beef or, fertilizer costs for farmers or coffee even, so it's a pretty easy solution if the president wants to take it. And the Supreme Court could give him a gift by giving him a way out here.
Henrietta, always great to see you and to have you on the show. Thank you.
Thanks for having me.
Hollywood loves a good wedding story, but the planned marriage between Warner Bros. Discovery and Netflix just got an I object by Paramount Skydance. They're sitting in the back row. This is what a hostile takeover looks like in real time. One suitor works through the family, gets approval by the board, that's Netflix. The other carries a big bag of money and makes another proposal. That would be Paramount. And on today's Stocks in Translation, we are breaking down the famed Wall Street hostile takeover. Let's start with the basics. A hostile takeover is an attempt to buy a company that its leaders oppose. The bidder goes around the board of directors straight to the shareholders and says, sell to us instead. If the board then digs in and opposes, that bidder can even try to replace some of the directors who said no. And an important point here, hostile does not mean illegal, just contentious. Think of it as the wedding crasher who knows the marriage license is valid but is willing to make a scene anyway. But none of this is new. Wall Street has been dealing with unwanted suitors for decades. In the 1950s through the 1970s, we had some early raids on undervalued companies. Investors figured out that they could study the books and uncover real estate or brand value that was hidden, then make surprise bids. Then the 1980s hit, and easy debt through junk bonds fueled corporate raiders. The poster child was the late 80s leveraged buyout of RJR Nabisco, sparking the now iconic book Barbarians at the Gate. Cheap high-yield debt meant anyone with a plan and a banker could try to crash a corporate wedding. And fast forward to the 2000s through today, and hostile moves are more targeted. They've tended to become more focused on mega deals and big brands like beer, pharma, tech, and now streaming media. So let's see how this plays out in the stocks. On this 6-month chart here, we have WBD, Paramount, Skydance, and Netflix. The line at the top is for WBD, up roughly 200%. That's what happens when a target becomes the belle of the ball. A friendly deal with Netflix plus a higher hostile bid from Paramount, and suddenly everyone is repricing the dowry. Then take a look at Paramount, the interloper, up about 25% in the middle. Sometimes the wedding crasher gets a pop too, if investors like the strategy or they think the bidder is undervalued. And then there is Netflix, down around 20% at the bottom. This is classic hostile M&A math. The suitor stock often drops because the market knows that someone has to pay. They might issue new stock and dilute existing holders. They might take on more debt and lever up the balance sheet, or they could spend the cash that could have gone to dividends and buybacks. Then you add in integration risk and regulatory risk, and you can see why the suitor's stock could take a hit. This is also where Wall Street makes money. Professional arbitrage desks, they will buy the target below the offer price, sometimes short the bidder, and try to capture the gap if the deal closes. Retail investors can ride along, but you must understand that you're really betting on 3 things all at once. Will the deal close? At what price? And how long will it take? If the wedding gets called off, that pop in the target, it can unwind fast. So what do we watch next in this Hollywood romance? First, watch WBD's stock price versus Netflix and Paramount offers. If the stock trades above the current bids, the market is betting on a higher dowry or a third suitor. If it slips back below, investors are starting to doubt that this wedding happens at all. Then note the board's response and any new defenses. Does WBD stick with Netflix, start negotiating with Paramount, or do they roll out more defenses? You might hear a wonky term called poison pill that keeps the crasher out of the reception hole. And then keep an eye out for antitrust and national security pushbacks. Regulators are going to look very closely at streaming media power, media concentration, and foreign money financing. A hostile takeover can only close if government officials sign off on the marriage license. And finally, watch for signs of higher bids or new suitors. Hostile situations have a way of flushing out every X in the Rolodex. If another media or tech giant decides this is a moment to shoot their shot, that could rewrite the whole story for WBD stock. All in all, hostile takeovers can create sudden winners, surprising losers, and a lot of noise in between. The trick is knowing whether you're catching the bouquet or paying for the open bar. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
A recent report from Realtor.com made headlines when it found the median age of all home buyers was 59 and first-time home buyers averaged 40. My next guest says those ugly headlines might make the housing market look worse than it is, and that there are some bright spots ahead in 2026. Jeff Taylor, Emphasis Digital Risk founder, joins me now. Jeff, that data came originally from the National Association of Realtors, and it was survey data, and it got a lot of attention, and people looked at it and sort of said, I'm never going to be able to avoid a house. Only people who are older can avoid a house. How did you interpret those numbers?
It's really great to see you, and thank you for having me. And so if you take a look at it, that survey, those numbers came from a survey that was 6,100 people, okay? So it's a very small subset. Number two, when you actually peel it back and look at what is the average median age for a home buyer, it's still 32 years old. It's been that way for over a decade. So when you really get to, and you brought it out, it really, really is there. So first-time home buyers, are in relatively good shape. And the reason why I say relatively good shape is right now, if I look at the overall market, first-time home buyers are still only 21% of the market, and that's a lowest number since 1981. So we definitely do need to see first-time home buyers coming back into the market in a more significant way. But we have a lot of optimism. I think they should.
Where does that optimism come from? What is going to change in this market that could make it more accessible to those first-time home buyers?
That's a great question. So as we look into 2026, right, we have a Fed who's going to most likely cut today, 25 basis points. And I think that we could see mortgage rates dip back into the high fives in 2026. So I think that's going to increase people wanting to come into the market, number one. Number two, if we look over national home prices in all states sort of came back around 3% last year for the first time, down. Now, that's nowhere near a market crash, right? A correction is usually 20%. But this 3% starts to show that it's becoming a little bit more affordable, and hopefully we see another 3 to 5% in 2026, so that can help affordability.
At the same time, when I talk to some folks within the fixed income market on which mortgage rates are pegged, they say even if the Fed starts to cut rates, we might not see, sort of those long rates come down that much, and therefore that we might not see mortgage rates come down that much. What do you expect?
That's exactly right. And if you look at the first two rate hike cuts that we had the previous year, actually mortgage rates went up. So when we see the cut today, I don't necessarily think that they're going to go up, but they could. But if I look into 2026, right, we're going to have a new Fed chair. And as we expect it to have the Fed rate actually cut a little bit more, as long as we don't have inflammatory concerns, then you could see mortgage rates come down. But if we're worried about inflation, then mortgage rates may come back up. So again, I don't think we're looking to see low fives in 2026, but the ability to get mortgage rates back into the high fives is something that we are optimistic on, for at least for a period of time in 2026.
And Jeff, I wanted to ask you about another stat, and this one came from Realtor.com, and it's about delistings, right? Somebody has a house on the market. It's not selling. They don't want to cut the price, and so they take it off the market. So we saw a 38% increase in those delistings year over year. What does that tell you about the market right now?
I think that ties back to the national decrease of home prices of about 3% over the course of the last year, is because people for a long time have been able to essentially name their price, and people put their house in the market, people are hitting the full price or a lot of times bidding it up, and that has started to shift. It is becoming more of a buyer's market. It's not a huge buyer's market right now, but you're starting to see that transition, which the first indication of that usually is people delisting because they get frustrated they're not getting their price. They go back, they sit in the sidelines for 30 to 60 days. Then they maybe have a little bit more of a dose of reality and they relist at a lower price versus accepting a lower price on their initial listing. The little bit of psychology, you need a little time to cool off and realize what the new landscape looks like, but that's what we're starting to see.
Jeff, we keep having a conversation about affordability. This is what everybody is talking about right now. And obviously housing is a big part of that. It's a big part of your monthly. It's the biggest part of your of what you're paying out monthly. What you're talking about is mostly some changes on the margins. Do you see anything from a policy perspective or anything bigger that is going to change the affordability, the housing affordability equation?
Look, we still have an issue, right? If you have the existing home price and new home price around $415,000, that is essentially still too high from an affordability perspective. But if I go back to January, mortgage rates were averaging around 7.25. Today they're 6.25. So on a 30-year mortgage, that on a $400,000 house, that's a savings of $266 a month. Again, that's not a silver bullet. You could still say that's a little bit on the margin, but I think things here are going to take a little bit more time, right? And then we could see mortgage rates come back down to where it could actually help on the affordability aspect, as long with also, again, as supplies that cost to make these houses, right, as the tariffs fall off and what have you, and the cost of materials to build houses come back, especially in that sector. I think that will become a little bit more affordable going forward.
We shall see. Jeff, thank you so much. Appreciate it.
Thank you.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.